So how do we invest without fear of, oh, it's going down, I need to take it out, or like trying to time it? How do we do that?
Great question. It's one of the main reasons I wrote the book. I always tell people, if you just read the second chapter of the book and nothing else, it'll change your life. You can do that with multiple chapters, but that chapter is really about teaching people that winter is coming. Yes. We all know winter's coming, right, to coin a phrase, but that winter is the best time on earth. And I know that's counterintuitive, and I don't mean like being a positive thinker. I mean pure facts. So in the book, I take you through 10 facts. I'll give you a couple of them right now. Yep. The first fact I give people is, why do people not invest? They're afraid of failing. If you're a millennial, right? Mm-hmm. So you grew up witnessing 2008 when you were still relatively young. How old are you now?
33.
Okay, so you were, what, 27? What?
2008, 27, I guess.
Yeah, 27, 28 years old. So you're a young man, and you're watching the world melting down in front of you. Yeah. For most millennials, they are the first generation since the generation that went through the Depression that is not investing at the ratio they need to, even close.
And they have more debt than everyone probably, right? With all the
They have more college debt than everyone, absolutely true.
I have a friend that has $400,000 in debt, dental school.
President Obama just paid off his debt 5 years ago while he was still president.
No.
I swear to God.
Oh my gosh.
It's mind-boggling. And he had a bunch of scholarships, but the last bit, it took him that long. So what I tell them is, listen, paying off your debt's not enough. You've got to become an owner, or you're always going to be in that place. So yes, pay off your debt, but here's what you need to know. You got to become an owner. You got to get in the game, but you got to understand the rules of the game. If you don't know the rules of the game, the old phrase is, when a person with experience meets a person with money, we know the phrase, the person with money ends up with the experience. The person with experience ends up with your money, right?
Yeah.
So I teach people the rules of the game so they don't get screwed. But the most important thing is this. Winter's coming, but people react. So let's take last year. Last January, 2016, we had the worst stock market opening in the history of the stock market. First, I think it was 10 days. Yeah. There was a drop of $2.3 trillion with a T.
Crazy.
Everybody's freaking thinking the bear market's here, the market's over, the crash is here. I think the market dropped 800 points one day. And on that day, all the richest people in the world were in Davos, Switzerland, for the big conference that they do every year. And they went there, MSNBC went there, and everybody's freaking, what are we going to do? And they said, let's go ask Ray Dalio. Now, your listeners may or may not know Ray Dalio as, if you're not in the financial business, probably never heard of him. You probably heard of Warren Buffett, but Ray Dalio's done more. You had to have a $5 billion net worth and $100 million to give him, or he wouldn't talk to you 10 years ago. Now, he doesn't give a shit how much money you have, he won't talk to you, because he's got a closed fund. But they go and they put Dalio on television, CNBC, he's the king. What do we do? And he says, well, you don't need to panic. Corrections happen all the time. Yeah. But you need a strategy that when markets go up and down, you don't go up and down. And he said, I spent 15 years of my life to perfect such a strategy. All of my money's in that plan. And he said, it's called All Seasons, and I've never revealed it before, but I gave it to Tony Robbins. He extracted from me, and it's his book. So you got to go read his book. This is what he says on national television the day the markets are crashing. And that day, to give you an idea, which is the beginning of February, I think it was 9 days into February, the market was down 9% in the first 5 weeks of the year. His strategy, which he gave me, which has made money 85% of the time for the last 75 years. Wow. It's averaged a 10% return, just under, and the average loss, when at 15% loss, was 1.6. Right. So if you go to Vegas and you could spend 85% of the time make money, and when you made money it was 10%, your loss is 1.6, you go forever. His plan made 2% while the market was down 9%. So it was up 11% difference. Now, I'm not suggesting that's the only strategy to do. There's many. His is the smoothest ride with the least risk. But what it did was a combination of that, and then right after that, I interviewed Fed Chair Alan Greenspan. He was the head of our economy, the most powerful man in finance for 19 years, 4 presidents. He was there running. I was just with President Clinton this last week. He was the Fed chair for him. And I interviewed him for like 2 hours, or 3 hours off stage, 2 hours in front. And I asked him in the very beginning of this thing, I said to him, I said, look, if you could be put in the Fed today, what would you do? And he looks at me, and as I said, he leans forward and he says, resign. So I look at that and go, oh my God, I need to write a book that'll free people. So here's what will free you. Everybody's afraid of the crash. So here's what you need to know. 2 terms you should understand. Correction versus crash. Anytime the market drops from its high by 10% or more up to 20, it's called a correction. Right. If it drops 20% or more up to 80%, like in, the Great Depression, then it's called a crash or called a bear market. Okay. So how often does a correction happen? How often do we have to be prepared for it? Since 1900, we've had a correction on average every year for 116 years. So when is winter coming? This year on average. It's like, how often does winter come? You wouldn't be surprised if it stormed and rained. Now, some winters are long, some are short, some are harsh, some are light, but winter always comes. So I wasn't panicked when this happened last year. I'm not panicked whenever it happens because I know it's supposed to be.
Yeah.
How long does it last? Average, 56 days. Okay, so just under 2 months. What's the average drop during that time? 14% over the last 30 years, 13.5 over the last 100 years. So I use the more recent one. 14% gets your attention, right? 14% you get a little gut check.
Yeah.
But here's what you need to know. 80% of all corrections never become a bear market. 80%. So all this fear, and what people do is what you said you did, is they see it, it's freaking out, I'm losing money, I'm the hell out of here, and they get out. The stock market never took a dime from anybody, only you can take it from you. You sold, that's why you lost.
Right.
So if you look back and say, what was it like in 2008? I can remember vividly being with my platinum partners and saying, you see these $80 stocks? This is 6 months before the crash. I told them in April, I brought them to Dubai, and I said, these stocks are going to go to 8 and some are going to go to $1.
Wow.
And by October, and I told them what to do, so they were able to get out. October, I go on the Today Show in October of 2008, and they go, Tony, there's been $3 trillion meltdown. Pump the country up. You got 4 minutes. like,
ready to go.
That's not what I do, first of all. And I said, that'd be a lie. I'm not going to pump up. At that point, the $80 stocks were 8. I said, some of those, I said, I'm not a market forecaster, but I work with Paul Tudor Jones, one of the greatest investors in the history of the world. In the biggest market crash in history, 1987, he made 200%.
Wow.
When everybody else was losing their entire life. And I've been coaching him continuously now for 24 years, every single day. Wow. So I said, I work with the best in the world. And they're telling me, based on history in the 30s and history in the 70s, this $8 stock, some are going to be $1. And I remember the day in March of 2009, Citibank, which had been, I think, $70, sold for 97 cents. You could go and take your money out of the ATM. It costs you more to take your money out than to own the bank, right? And then I told people it'll jump from 99 cents to $6, $10, $12 in a month or two, and it's exactly what it did, right? So what you got to know is corrections happen every year. You got another couple of months. You got to know it's 14%, and you won't lose because 80% of the time it doesn't go to a bear. Now, what about the bear? The bear market, it happens, to give you an idea, in the last 100 years, every 3 to 5 years. We've gone 8 without one. We're way overdue.
Yeah.
So in modern years, last 30 years, it's about every 5 years. The average length of a bear is 1 year. The average drop is 33%.
Wow.
A third of those drops go 40% or above. That, I don't care how well prepared you are, that's a scary thing.
Yeah.
But it is the greatest opportunity in your lifetime to go from wherever you are financially to where you want to be. I hope your audience is listening right now. Hear me. If you want to leapfrog and you're a millennial and you think there's no future, or you're, a baby boomer and you think you're too old and it's too late, the greatest gift you have is coming. I know it doesn't sound like it. This is not positive thinking bullshit. This is the truth. Wall Street, the stock market, is the only place that when things go on sale, people freak out. If I said, you like Ferraris?
Sure.
If I said to you, Ferraris go on sale for 50% off.
Awesome.
But when I tell you Apple's on sale for 50% off, you go, oh, what am I going to do here? What's wrong? The whole world's coming to an end. If you think about it, how old are you?
33.
33. So let's assume if you were 35 and you lived to 85, you got 50, 52 years ahead of you. That means you have 52 more corrections to live through.
Right.
That means you're probably in those 50 years going to have 10 more bear markets to live through. If you're going to have a gut checks every time or you're going to leave out of it,
right.
If you didn't participate because you thought, oh, the market's too volatile, I can't trust it, all that stuff, you missed 250% return in the last 8 years. I mean, you've missed out on everything while you're waiting for things to be better. And if you won't do it when it's like this, when it crashes, you're not going to get in.
Sure.
So here's the good news about the bear. The good news about the bear, average ones a year. Could be longer, but that's the average. Could be shorter. But here's what's cool. Every single bear market in the history of the United States has led to a bull market, meaning right afterwards. So 2008, This plummeting, what happened in 2009, up 67% in a year. I can show you every single bear market, and the next year when it comes out, it's this explosion. Now, that's not true in every market in the world. It's true for 2 centuries in the United States.
Wow.
So that's why Warren Buffett says, I want to be greedy when people are afraid. And I want to be afraid when people are greedy. If you remember 2008, he was telling everybody, buy. He was having the time of his life. Buy, everything's on sale. So what you have to do to become unshakable is the metaphor I use is turn the snake into the rope, meaning we all know the story. It's the middle of the night. You're walking through the yard or someplace and you see a snake and you're freaked out. You pull back, you come in the morning and it's a rope. Once you know it's a rope, you're never afraid again.
Yeah.
I want to take for people investing and show them how to turn that snake into the rope it really is. And I'll tell you one final stat on all this. People always say, and you started to bring it up, timing. How do I time it? Like right now, things are too expensive. I want to wait. People have been saying that for 8 years. Is there going to be a correction? Yes. Yeah. But when it corrects, you want to invest again. You'll get dollar cost averaging. If you paid a little too much here, you'll paying less here. It'll bring the average price to a reasonable place. It's going to allow you to succeed. But here's what people need to know about timing. If you are not in the market, it's the most dangerous thing. This is so counterintuitive, so I hope your audience is listening. Let me show you. There's 2 different research projects. One was done by JP Morgan. I just spoke for them the other day at their Alternative Investments Conference. And to be in the room, there are 400 people. You have to have $1 billion net worth to get in the room.
Crazy.
It was mind-boggling, right? So JP Morgan did a study, and also Schwab did a separate study, 20-year studies. In the last 20 years, to give you an idea, the average S&P 500, that index, has produced 8.2%. Over 30 years, it was 10.28. But in the last 20 years, a little bit less. Still great. You double your money, roughly you're in a position where you double the money a little more than every, what is it now, 7.2, so it'd be like a little more in 10 years. But here's what they found out. If you miss the 10 best trading days in 20 years, because you're trying to time the market and you're not in it during one of those days, you went from 8.2% return over that period per annum, per year. It dropped down almost half, 4.5. What are the chances of you knowing the best 10 days to trade in 20 years? None. Right? Warren Buffett said, market timers and market forecasters are only there to make fortune tellers look good because no one can do it successfully. Even if they do it for a while, it doesn't last. It's luck. Jack Bogle told me, he started Vanguard, $3 trillion company. Wow. He said, we took gorillas, 1,000 in a room, and had them flip coins. And we said how many times they got heads, how many got tails. Just gorillas flipping them randomly. And he said one gorilla in that set of those turns flipped heads 21 times in a row. Now, when you look at that and see all these gorillas doing it, you look out and say, what a lucky gorilla. He said, but in the hedge fund industry and the mutual fund industry, when somebody does 10 in a row, you go, what a brilliant investor.
Right, what a genius.
And it's just averages and luck at that time.
That's it, yeah.
In fact, he showed me that 96% of all mutual funds fail to match the market over a 10-year period of time. Only 4% make it, and they're constantly changing.
Crazy.
So the statistic I want people to know is, if you miss the 20 best trading days in the last 20 years, just 20 days in 20 years, one day a year in 20 years, and you're wrong on timing. Your 8.2 doesn't drop to 4.5, it drops to 2%. You might as well have been owning a bond and have no and have no risk.
Right.
If you miss the top 40 trading days, to give you an idea, you are minus 2%. So you got to get in the market. And if you're saying, what about my timing though? Study was done by Schwab. If you got the perfect timing for the year, the right day, the best possible day to buy, some people, the worst day, someone else dollar cost averages, just keeps spending the same amount every month regardless of prices, and somebody stays in cash. Who has the worst return?
The guy trying to time or no?
Cash.
The cash.
You get nothing for cash.
Gotcha.
The guy who was the best had the best timing.
Got it.
The guy that was the worst, the guy that dollar cost average and the one that was on the worst day were almost identical, but after 7 years, there was only a $20,000 difference in accumulated assets between the worst day and the best day. The worst was not being in the market.
Right.
So you got to be there. And I'm not saying put everything in stocks. We teach in the book all these different assets to diversify.
Yeah.
But stocks in the last 2 centuries have provided the highest return. So you have to have significant exposure to that if you want to get the highest return.
Got it. And what I love in the book, you say that 80% of financial success is psychological, 20% is mechanical, right?
Yes.
So it's not about timing and trying to like figure all these things out and when's the best thing or the best fund or best
This is not
whatever.
about trading, it's about investing.
Exactly.
Trading is trying to do that, and most people lose money trading. Even the guys that tell you make money, see it all, they're making money 2 or 3 years from now. They usually eat the dust, right?
Exactly.
So yes, you've got to have the psychology, and my best way of psychology is not to pump you up. If you want to be unshakable, you want to be educated, and you want to know the facts. You want to know, look, every 5 years, I'm going to get a bear, maybe 3 years. I'm going to get a correction every year, but I'm going to be in the market and make money. Do you know that 6 of the 10 best trading days in the 20 years happened within 2 weeks of the worst trading day? So people need to understand you got to be in the market because the worst days will bring you your best days.
So all you need is an image and an emotion, a thought and a feeling, a stimulus and a response, and you're conditioning your body emotionally into the past. So now, the memories, and this is just not in the brain now, it's in the body, okay? So now, that thought of that person